Hey, good morning, everyone. Welcome to the Macro Snapshot. We are Thursday, June the 25th, 2026. So obviously, we had the Micron earnings last night. They came in very, very strong, much stronger than the street had expected. So if we look just at a few different ways of looking at it, I've just got pulled in some bit of sort of the data here. Just so you see the third quarter, the beat revenue estimate by 16.8%. The guide was beaten by 23%. GPM beaten, et cetera, et cetera. EPS super strong, beaten by and the guiding. So the point is that everything here, as you can see here, lots of beats, revenue, everything. And if we look again at quarter four, so that's going into the future, you can see that the estimate was for 43 billion, and the estimate came in at 49 to 51. So a strong beat going forward on the forward guidance. You can see that EPS of 30 to 32, beating estimate of 25 going ahead. Adjusted gross margin 86%, beating estimate of 83, etc., etc. So less expenses. And then if you actually look at from quarter three, you can see that all basically good news. So adjusted revenue 41 billion above the street, thinking 35. Et cetera, et cetera. A gross margin much higher than the estimate, operating income, et cetera, et cetera. So all across the board, not only was quarter three good, but quarter four was very, very good. So obviously, very, very positive there. So if we just look at the markets, this is going to be good for the market in terms of the AI sort of a narrative. And if we just have a look at sort of Micron, it's up about 10-15%, something like that. So you can see in the post market here, you can see that it's up about 15% or so. Interesting, because the options market yesterday was pricing, I think, about 11 or 12% maximum move. So anyone with a straddle may have actually made a little bit of money on that one, but we'll see the volatility crush coming down, of course. But anyway, so the point is that Micron up pre-market, and no surprise here that the Nasdaq is reflecting that. So you can see that Nasdaq after the market yesterday, or after the 4 o'clock release, had a nice powerful sort of push upwards. So overall, this is going to be great for the semiconductors, for the memory, and all of those markets are going to be sort of very much sort of the stellar performance. So if we look at SMH, you can see the pre-market up to 647, so that's going to gap higher. We can also see DRAM, which is specialized, of course, in the memory. You can see that DRAM's going to gap up probably to almost about $79 or so. So that's very much where the action is at the moment. Now, what is interesting is that if we go back to our dear old friends, sort of IGV, which is the software, of course, you can see that in the pre-market, if anything, that's down a little bit. And as I was saying yesterday, down below the Fibonacci 61.8% sort of fib retrace here. So this is not looking great. The bulls really today or tomorrow have to kind of step in here and stabilize this. If not, you can see that this outperforms this divergence between the semiconductors and the memory chip making companies versus the more, let's call it, traditional software or SaaS companies is going to continue. We can also see here in the Mag 7, even the Mag 7s here under a little bit of pressure. They're falling below the 200-day moving average, falling below the 50% fib retracement here. And so we're starting to see that sort of divergence here, that the money is still flowing very much into the semiconductors and the memory names, and less so into the overall the Mag 7s and the hyperscalers, and definitely probably actively flowing out of the software. So we're continuing to see all of that. But overall, this is a positive news with Micron for the NASDAQ. And getting back here to the NASDAQ, you've got to say here that we are just looking here at just the technicals. You can see here that we sort of dip below the 61.8% fib retracement here, but it looks as though it's going to sort of push a little bit higher, although it could push a little bit higher. Now, if I actually just break that down onto a 4-hour chart, which is what I want to do, I just want to see here what the bears would need to do, or where we could think that this may not actually be making a new all-time high. So let's have a look here. And what I want to do here is to put on a fib retracement, which I'll put my fib reversal. So let's just have a look here, look at the next key, the next key levels. So what you can see here is that we sold off, and then obviously we had that positive earnings from Micron, and then overnight it's continued to grind a little bit higher. But at this point, we're at the 50% retracement level on Nasdaq, which comes in on the futures at about 30,120 or so. So really, this is looking good at the moment for the bulls. The bears at this point, the last line of defense would probably be the stall line, might be 30,315. So personally, today, the key number I'm looking at, or the key level on Nasdaq, I want to see if they can push it. The market can push it above 30,315. And if that's the case, that would clear the 61.8% fib retracement. And that looks, and if that were to be the case, we could then see that pushing to test these recent sort of highs. On the other hand, if we start to stall out here at this sort of 50%, about 30,130 level, or certainly at the 61.8%, the fib pocket here around about 30,300, 30,500, something around about there, that could indicate that this was just an immediate pop on Micron, and that's enough. Now, keep in mind that Micron, as we saw in the post-market, already is up 15%. That is significant. And as we saw, the market was expecting really good earnings. This was a blowout number, so it is very, very positive. So for me, what's going to be most interesting today is really to see if the market sort of takes this good earnings from Micron and run with it and say, okay, this is great. All clear, blue skies ahead, and the leadership role assumed by the semiconductors will be enough because, again, going back to the daily charts here, if we look at something like the ES, you can see that, it's still got a little bit more work to do, and we're not nearly at the same kind of level here. And if we're, again, just looking at that fib retracement here, you can see here that compared to, let's say, the Nasdaq, you can see that we haven't even retraced here 38%. So definitely a lot weaker there on the overall, let's say the S&P 500, so to speak. So let's keep an eye on that sort of a relationship between the two. On the other hand, the Russell, where's the Russell? The Russell is doing pretty well. So the small caps almost at highs. So overall, doing pretty well. Now we're going to get a bit of a read today on the state of the general economy because we all know that the semiconductors and the memory is doing super well and there's a huge demand. But really, what's going to be interesting is just in terms of the general economy and where we're going to go into the future. We do get some data today. So what we do have today, we have the core PCE. Now we know from the CPI and the PPI inputs that is expected to be hot. And if we actually just look here, we know the headline number is going to be very, very hot, 4.1 year over year, which is the median forecast. If you look here at a lot of the big banks of sort of forecast here. So month over month headline at sort of 0.48 rounded up to 0.5. So that's not where the Fed wants to be at all. And we know the headline number here at 4.1. Keep in mind, in theory, the Fed's sort of target here is 2%. Now, if we look at the core, though, the core is expected sort of for the median forecast here, as you say, 3.4%. And up from last year's 3.3. So 3.4 for sort of for the year over year number. So that is not good at all because that's meant to be 2% as for the Fed's target. But even if we look at the month over month number, 0.35, 0.36 is really what a lot of market participants are thinking today. So just keep in mind, guys, a couple of things here. First of all, a high number is expected because we know that oil, this is backward looking, of course, and we know that sort of the oil number has been very high in the energy complex. But having said that, that's going to be mainly in the headlines. So what's also going to be interesting in the core is that if we get a 0.35 or a 0.36, we might get an unrounded number or a rounded number of a 0.4. So there could be an initial spike higher here. So I'm just kind of curious, keep an eye on the unrounded number. So if that comes in at 0.35, but the headline number shows 0.4, keep in mind that it's, mid threes rather than a 4. And keep in mind also that the market very much is expecting a much higher number. And we know that oil, for example, has gone down a lot, which we'll get to in a second, over the last, sort of week or so. And so it could this be a case that the market is saying, hey, this is all backward looking data. Now, just talking about the other data, what could actually be pretty interesting, we've got it here somewhere. Let me just bring it up. I don't know, where is my data, oh yeah, economic calendar. So what you can see here is that we also have sort of personal income and personal spending, and we also have durable goods. So apart from the PCE data, what I'm going to be looking out for, I want to see if personal income is sort of continuing to rise, or is that sort of plateauing? Also, personal spending, does that continue to rise? And what we're starting to see is the K-shaped economy, that about 50% of personal spending is actually only about 15 to 20% of of the economy. So it's really that top echelon of sort of earnings and the wealth effect, which is keeping our sort of personal spending afloat. The other interesting data, which we're going to get today to keep a looking out for, is the savings rate. Now, it's going to be interesting to see, is the savings rate going down? Because if the savings rate is going down, that would indicate that people are starting to do it a little bit tougher and they're dipping into their savings. And that would forecast or potentially or presage that further out in the year, maybe the economy, consumer sentiment is actually going to be going down, which could forecast maybe a sort of a slightly weakening sort of economy or consumer sentiment and spending as we go into the second half of the year. So as I say, today let's keep an eye out for the core PC. That's the important one. But as I say, any knee jerk, let's see if that could be a fade potentially. The other, as I said, keep an eye out for the savings rate. Is that coming down? Now, just in terms of other stuff going on, I just want to go and have a look at the oil market here. So if we look at oil, you can see here, especially on the Brent here, so you can see that the Brent oil, which is the one which is the closest, which is the global sort of benchmark, and also the one which is closest, most heavily affected by what's happening in the Middle East. You can see very interestingly, that's completely closed the war gap. So if we go back here, Friday the 27th here, you can see that we're all the way down there. And not only that's also being sort of reflected in the WTI, not quite as strong in the US. There's still a bit more demand out of the US. We haven't filled in this gap, as you see here. So the key in the WTI for those trading that, obviously, we're below the 200-day moving average here. And we have the 67.77 is local sort of support down there. We haven't closed that gap. But really in the Brent, what I want to show you guys, what was quite interesting is also the shape of the curve here. And we can see here that the curve spread, which just to put that in context here. So if we look at pre-war 27th of February, you can see was a very soft sort of backwardation here. So the prompt contract, the front contract, slightly more expensive than the back of the curve, but relatively shallow. And then if we look at the peak of the war, which is the 29th of April, you can see how we had this crazy sort of backwardation. So there was a massive premium for sort of front delivery barrels, and we were, the pricing was all the way up here. You can see how much, but look at the steepness of the curve. So not only has the outright price gone down, the basic price, but we can see here that the shape of the curve, the latest, we're actually now fractionally into contango yesterday. So that means the front barrels are actually trading at a small discount to barrels for further out delivery. But essentially we've closed all that. So as I say, the price has come down, but also the curve. So what is this curve telling us? This curve is telling us that there's a lot more oil coming, starting to flow out of the Persian Gulf, and that the market is actually, for crude oil, starting to price in a sort of an oversupply. Now, that's going to be deflationary. And there's a couple of other just little headlines we're getting, which is supporting this sort of slightly bearish oil narrative. Is that we saw overnight the Iraqi oil minister was saying that Iraq wants their quotas from OPEC to be pushed higher. They want to produce more oil, and if they don't get that, they're threatening potentially to leave OPEC. Now you remember that during the height of the war, like sort of a month ago or 4, 5, 6 weeks ago, the UAE basically left OPEC. So what's interesting is that we had the UAE leaving OPEC, and now we have Iraq potentially threatening to leave OPEC. So it looks as though there's sort of discontent and discipline within OPEC members is maybe starting to break down a little bit. And that would mean that those members who are able to produce more will produce more. And that's going to put downward pressure on oil, which of course is deflationary. We also had some headlines overnight that the largest sort of refining sort of terminal in Saudi Arabia, the Ras Tanura, which produces about 500,000 barrels of oil per day, they basically have sort of switched on the flow again, and they're starting to produce again and to refine again. And that means that sort of more oil coming out of Saudi Arabia is a distinct possibility going forward. So all of that stepping back, we see that the oil market It's definitely sort of starting to be sort of perhaps even a little bit oversupplied. We're seeing all of that. It's going to be interesting to see in Brent if that sort of stabilizes around here. Is that sort of the bottom at the moment now that we've achieved that sort of pre-war level? But what we do know is that overall this is pretty good news for the deflationary camp, especially if you look here at the long end. You can see, look at these yields here on the back of this sort of lower oil. Especially, you can see that the as oil's come down, you see the 30-year bond yield has come down. It was at over 5%. Well, obviously in the peak of the war, whatever was up to about 5.1, 5.2%. We're now at about 4.85. So the back end of the yield is coming down. Trump and Besant are going to be very happy about that. You can see also the 10-year yield now down well below 4.5 at 4.4. Front end pricing remains, it's come down a bit, but it's still pretty elevated here. So really, a couple of things going on in the bond market here. It's that the curve is flattening, and that's indicating obviously that the oil prices are down, so less concerns about inflationary pressures from the energy complex. But is this also sort of indicating, if you look at the 10-year here and the 30-year yield, a little bit of concern or sort of a forecast that the US economy and economic activity might actually sort of be softening a little bit as well? So that's kind of interesting to think that, with this sort of relatively sticky inflation, maybe the labor market is okay, but in the productive sectors, the labor market is not doing that well. Keep in mind that for the labor market, employment is okay in the US, but that's also because of complete lack of immigration. So there's not more workers coming into the market. And secondly, most of the gains have been in like sort of, relatively low wage hospitality jobs, sort of home healthcare jobs, and just healthcare sort of help in general, and some education jobs and government jobs. But in the productive sectors, we're not really seeing that. So, let's not get carried away with the health of the US labor market. Uh, and the long end bonds with the yields going down seem to be sort of looking ahead and saying, maybe growth is not going to be so high and inflation definitely is not going to be so high. But what is going to be interesting is also just to see how the front end of the curve reacts, because we see here that, let's say, the 2-year yields have come down a little bit in the last couple of days, but they're still at a pretty elevated level. And if we look at the 1-year yield, you can see that that's still pretty elevated as well. And if we just go and look at sort of pricing for the Fed, you can see here that just looking on the GM dashboard here, you can see that the market after the hawkish commentary from the Fed and specifically Kevin Walsh, you can see here that the market, if we see what's priced in, you can see that by the October meeting, we've got 26 basis points. So a full hike is priced in by October, and about an 80% chance of that is priced in, 82% chance even by September. So basically by September, October, the market's pricing in a hike. And if you go out by the end of the year, you've got sort of essentially, 1.4 hikes, going out. So is this a little bit too hawkish? It's interesting to think that, if we don't see the labor market particularly sort of booming more, and we see, for example, in today's data that core PC, let's say core PC today comes in at 0.2, that's going to cause a huge sort of bump in the front end. So let's say the SOFR or the 2-year yields, they'll rip higher, those yields will come down. So it's going to be interesting to look there. Also today, if we see that personal spending is coming down, personal sort of income is coming down, maybe the saving rate is coming down. What I'm trying to say is that if we get any hint today that inflation is not as nasty or sticky as expected, especially in the core number. If the core number comes in, and also the general metrics that the saving rate is coming down, maybe personal spending and personal income is flatlining or coming down. I think there's a real possibility here that the front end of the curve could get a boost, and we might see that not only the back end yields coming down, but the front end yields coming down, because it seems to me that pricing is a little bit too hawkish. I personally don't see a Trump appointed chairman hiking, almost up to, maybe like twice in the next 6 months. That to me seems a little bit hawkish. So that's definitely maybe some Fed funds futures, or even just play the ZT is not going to, will love that. So that's an interesting one as well. Even over in Europe, just while I've got this up, if you look at what's priced over in Europe, you can still see here that the European markets for the ECB is still pricing by December here a full hike, and even a little bit more going into sort of next spring. So I think some of these sort of markets are a little bit sort of overdone, and that's going to be interesting. So Let's have a quick look, guys, at the dollar. The dollar continues to be very strong, just sort of stalling out a little bit. And what is interesting here is that even though the long-term yields are coming down, the dollar has remained resilient. The geopolitical risk seems to be reducing a little bit in the Middle East, but the dollar has remained resilient. So the point is here is that the dollar seems to be taking its cue a little bit from the front end yields. We've seen that the Fed pricing is very hawkish, and the two-year yields are pretty sort of hawkish at the moment. So that's sort of giving the dollar quite a boost. So again, it's going to be interesting to see if the economic data which we get at 8:30 this morning is a bit softer. And I think if we do get to see those front end yields coming down, there could be a case here for the dollar to start stalling out a little bit. We see that it's pushed through a lot of levels. You see here in the euro, it's pushed through. Obviously, against the Japanese yen, we're at pretty critical levels, almost at 162. So let's see if the dollar can, sort of push through these levels. What would necessitate that? A higher than expected core PCE today. And obviously, a strong economic data could throw more fuel on the fire, and we could see a pop higher in sort of the dollar against most of the other currencies. Other thing to keep an eye on, or we do have some Fed speakers today talking about that. Now, we've heard a lot about the hawkishness, but today we have Bowman, who she's probably one of the most dovish. So let's see if she sort of presents the dovish case for a bit of sort of a pause. And we also have Williams from the New York Fed. He's not a super dove, but he's sort of more, I'd say, as a centrist. So it could be interesting today if we get a slightly more sort of dovish or sort of balanced view, putting together the case for sort of a less sort of hawkish commentary. That's definitely going to be something to be interesting in. The other thing as well, guys, I just want to have a quick look here over at gold, which has been sort of beaten down, as we know. And if you look at gold here, let's look at the spot gold. You can see here it's gone, obviously, it's well below the 200-day moving average now. It's broken through local support here. You see these levels at 4,100. It's broken through all of that. So at this point, it's also broken down through the much longer term, going back to late 2022, 38% fib level, which was at 4,090, is broken down through that. So at this point, the next target on the downside would be this local support at about 38.85. And if we look on the futures contract going on to that, we've actually broken down through that. So the futures even worse than the spot gold. Now that's because now what's going to sort of stabilize that? What would stabilize that is the yields in the US coming down, specifically the front end yield. So we're going to have to see a sort of a slightly more dovish repricing of front end yields. And concomitant with that, we're going to have to see a weaker US dollar. And just generally, the macro environment has to be a bit more, sort of favorable, sort of real yields maybe coming down a little bit, the US dollar weakening a little bit, and a hawkish pricing for the Fed. We don't exactly have that yet. But let's see if that starts to stabilize today. On the other hand, if we get all the hawkishness, so very strong data today, a stronger US dollar, stronger nominal yields ripping higher, and maybe even real yields ripping higher. There's no reason here why gold and silver as well cannot sort of fall a little bit. So it's probably still a little bit too early to dip the toes into gold. You see here silver also looking maybe for some support here around about $49. And just to put that all in context, just want to finish off just showing you some of the sort of the cross factors affecting gold here. It's from Bloomberg and Sachs, so this is a nice data here. So you can see here, Fed funds futures still pretty the pricing for the Fed still pretty hawkish. That needs to come down for gold to sort of stabilize. You can also see here that the 10-year yields, which is inverted here, you can see as the red line, the yields going sort of higher. That's also meant that gold in the blue here has gone lower. So that needs to come down a little bit. But as you can see here in the bottom right-hand graph here, yields are starting at the long end, at least, to come down a little bit. So that might start to help gold stabilize and find a sort of a base. Secondly, if you look here at the Bloomberg dollar index, not the Dixie, but the Bloomberg dollar index, which is much better, actually much more global. You can see here that the dollar, this is inverted, is ripping higher, and that's just keeping gold under a lot of pressure. And the other thing as well, is just sort of from a positioning point of view, you can see here that the future speculators on the COMEX, there's been a lot of selling over the last sort of month or two or so, and that's starting to stabilize a little bit. So a lot of those institutional sort of investors have sort of puked, so to speak. but they're now starting to sort of stabilize. And what we also need to see stabilizing is the ETF holdings. So things like GLD, which has come down a lot. And really what we're going to have to do is to keep an eye on the bleeding from some of the ETFs. We need to see a cessation of the outflows in the GLD and need to see some money being put to work. So all that to say that gold are still under a bit of pressure, as is BTC, by the way, silver and all the precious metals, palladium, platinum, they're all under pressure, and even copper as well. So we really need to see the conjunction of a more dovish Fed pricing coming in. And also the yields coming down, especially at the front end, and of course a US dollar, which sort of just takes it easy for a little bit. So, okay, guys, so that's it. Let's keep an eye on the semiconductors today. Micron, let's see if Micron pushes higher, or what we saw in the post market was sort of the the peak of it. Let's keep an eye on that. Okay, guys, that's it from the macro snapshot today from us here at the Macro Shop. Keep an eye on things at the Macro Shop on Twitter, on YouTube. Some interesting things coming pretty soon, so keep your eye on that. Thanks very much. Have a great day. I'll be back tomorrow with the Macro Snapshot from the Macro Shop. Thank you.